Scipion Capital is an Africa-focused hedge fund created 5 years ago. The firm's chief investment officer, Nicolas Clavel, talks to GTR about how private funds like Scipion have filled the trade finance gap left by stringent new banking regulations and effectively helped banks keep their business despite reduced lending capacity.
Initially, the focus was purely on agricultural. During the crisis of 2008, we had a very strong shift towards essential commodities. And for the last 2 years, we have seen a lot of demand for our product for ores, chrome ores, manganese ores, iron ore, even copper, cobalt, and all kinds of ores used in technologies. A lot of it going to China. In the past 12 months, our business has more than doubled. And we're about to, again, increase it by another 200 or 300% in the next 6 months. With the new regulation of Basel II and Basel III, a lot of the smaller and medium-sized traders in the financing community were going to struggle to keep the same level of credit line from their banks. The banks have shrunk a little bit their line, but even more importantly, they have actually focused on the very big companies. So the very large trading houses are finding very competitive credit, and the smaller trading houses are finding very little credit. Our main role is to basically allow a small trader to offer the kind of terms a big trader would offer at the mine, but at a better price. Some bankers perceive us as competition, but most of them see that we can add value to their business and help them keep their client by offering things that they cannot do. We've got also bankers calling us, listen, I can only help this guy once the goods are on the ship, but he really needs the funding for the previous 10 days to bring the stuff to the ship. This is the kind of transaction that we do quite a lot. Short-term bridge financing to allow a trader to basically negotiate his LCs. In emerging market, but particularly in Africa, I know of a lot of banks who have lost their confirming line. They've lost their treasury lines from European banks. And it's not that they were a worse risk. If anything, it was actually probably bank lending, which is a worse risk. But nevertheless, they suffer and that has constrained their own opportunity to meet their own clients' demand. We try to work in conjunction with them by maybe they provide a couple of $1 million to the client, and we also provide 2 or 3 million. And for the bank, the plus is that that deal has not gone to a competitor. That's another source of transaction for us. This middle market, I would say, is increasing in size and in demand because of the bank's contraction, and could be calculated in billions of dollars. We see continued growth in Africa. We see much improved infrastructure in the continent. All of that makes access to goods, transactions which 3 years ago would have been completely unrealistic, are becoming realistic. With interest rate at zero, as we have in all major currencies, anybody who does asset allocation has got to start thinking, okay, well, I need to earn money on my capital, and where do you get a return on your money? Well, emerging market is a general concept, not just in Africa, but emerging market in general actually is a good place to get a return on your money.